Hey everybody, it's Craig Berry, Atlanta's #1 mortgage professional with Angel Oak Home Loans. Today I'm going to talk a little bit about 30-year mortgages versus 15-year. There's some very obvious differences, such as 15-year is a shorter term, so you're going to pay less interest, but you're going to have higher payments. On a 30-year, you're going to have a slightly higher interest rate, but you're going to have a lower payment, but you're also going to pay more interest because the term is twice as long. So let's kind of put those into specifics. We'll take a $200,000 loan, for example. On a 30-year, not always, but generally, you're going to have about a 0.5% higher interest rate. So let's just say today's 30-year rate is 4%. Then a 15-year rate is going to be roughly 3.5%. On a $200,000 loan, on a 30-year mortgage at 4%, the principal and interest payment, not including any taxes or insurance or escrow, would be $955 per month. Take that exact same scenario, which is a $200,000 loan, but reduce it to a 15-year term at a 3.5% rate, you're talking about a principal and interest payment of $1,430 a month, give or take some change. That's $475 a month more than what it would be on a 30-year. So it's a lot more money. However, over the life of the loan, by reducing that term from 30 to 15, you'd save over $86,000 in interest. That's huge. However, it all depends on whether or not there's that ability, that affordability, and also the comfort. You may be able to afford it, but you may not just be comfortable with making almost $500 a month more every month in principal and interest payments. So some other options: pay a little bit extra on your 30-year. Remember, if you pay one extra payment per year on that 30-year, you can reduce it by over 4 years and save $22,000 alone. So maybe you can't afford the 15, but maybe somewhere in between if you're disciplined about it. So say like every year when you get your tax refund, make an extra payment towards it and reduce it that way, rather than being committed to that 15-year. Another option that's very rarely talked about is a 20-year mortgage. A 20-year mortgage usually has about 1/8 to 1/4% lower interest rate, and that alone could save you $58,000 to $60,000 over the term, using that same scenario on the $200,000, and instead of 4%, you'd be looking at 3.7 or 3.8. But again, you're going to save almost $60,000 in interest. So bottom line, what's best? Well, it just depends. Can you afford the extra payment? Are you comfortable with the extra payment? Can you still have your nest egg for emergencies? Can you still put away for savings and retirement? Because if that's the case, then it's a no-brainer. The 15-year mortgage is obviously going to be the best one for you. But how do you know for sure? Talk to your trusted mortgage advisor. They can point you in the right direction based on your needs, based on your family, based on what you're trying to accomplish. As always, if you'd like to talk to me about this or anything else in further detail, I can be reached at 404-642-6700, or you can email me at craig.berry@angeloakhomeloans.com. Until next time, thank you so much for watching and have an amazing day.